Going live now, 1 minute to go.
I always feel like we're about to launch a rocket, you know. We'll leave that to Elon Musk, shall we? Okay.
I see
He's too busy with other things. He doesn't have time for rockets.
He's very busy.
Well,
Yeah.
The astronauts are ready.
He's now a politician. Okay. Okay, fantastic. Yeah. Fun and games. The speculation's all about how long that's going to last now, that new friendship. The bets are on those. Okay. Okay, welcome everybody to the Global Energy Outlook Forum 2025. We are now at the start of our Europe session. We have just started actually half an hour ago with the two feature interviews, which were focusing on energy security versus energy transition. And now we've got the first of our panels for the Europe session, which will be discussing what the top three trends will be, in our panelists' opinions, impacting the direction of oil markets in 2025. I'm delighted to be joined by Dr. Jeff Brown, President of FGE, Alex Schindelar, President of Energy Intelligence, and Adi Imsirovic, Director of Surrey Clean Energy and Senior Associate at the Centre for Strategic International Studies. So great to have you with us, gentlemen. Thanks so much for joining us. Lots to talk about in the next half an hour. Adi, let me start with you. We want to look forward as much as we can and not look back too much in this forum. But my question to you is, whether you expect to see, a significant change in, let's look at the geopolitics first of what impacted oil markets last year. A lot went on, but admittedly, oil markets were adjusted and we didn't see as much disruption as we thought we would. What is your forecast going forward for the year ahead on that front?
Absolutely. I think that's one of the key trends that was impacting the market last year, and I think it will continue to do so. And the reason for that is obviously that we have the United States as the biggest producer of oil in the world. That's really alleviated a lot of, removed a lot of problems in the oil market, a lot of worries by players compared to the time when we are entirely dependent on the Middle East for any additional production. What is more, we have a large excess capacity within OPEC. We know there's the magic 2.2 million barrels that OPEC is really gagging to get it into the market. And I just don't see how that's going to happen, but we'll come back to that story later on. And then we have a big story of potentially peaking oil demand. The jury's out whether it's going to peak in this decade, but to me, it looks very, very likely. China being the big part of that story for two reasons. First of all, slowing growth in China, but the second reason being again, strategic and geopolitical situation. Probably, I've never seen China and the United States being so much at sort of opposing each other on so many issues. And if you're sitting back in the sort of Communist Party meeting, you're looking at your imports of 13.5 billion barrels of oil every day. I think China is dreading it. And I think China is very much driving this move towards electrification of the country and including obviously growth in demand for coal with all the other implications. So EVs are obviously a very, very big part of that story this year. In particular, I think they've become mainstream. In the UK, 1 in 3 new sold cars is electric, and UK has never been at the forefront of this new movement. So it just tells you how suddenly and quickly this is all happening. So I think the market and traders are sitting back and saying, okay, yes, we're going to have an increase in demand next year of just over 1 million barrels probably. We've got 1.8 million barrels probably coming just from non-OPEC. Yeah. And OPEC sitting on 2.2 million that they would really like to put back onto the market. Why should we worry? And that's the reason for the low volatility and the market just sitting in a range, whatever, 70 to 85.
Okay, thanks, Adi. So, I mean, Alex, taking those points into consideration, again, like, the question for us to answer here is what are the top three trends? The trends last year were geopolitical disruption, changes, oversupply, as Adi just pointed out very well. Would you say those are two trends that will continue firmly? Do you identify anything else that you saw that you might see coming to the fore this year that we didn't see necessarily ingrain itself into oil markets last year?
Great. Thanks, Dyala. Thanks for having me. I think we see three main things that are driving markets this year. One would definitely be geopolitics. Second would be demand. A third would be OPEC policy. So I don't think there's a surprise. So which of those three will dominate? And if you remember 12 months ago, we were coming off the back of the October 7th attacks in Israel, and I think everyone was sort of saying it was going to be the year of geopolitics. And as Adi says, we did have geopolitical events, but actually the market sort of adjusted and it was able to deal with the disruptions that were there. But if you think about it, there weren't that many physical disruptions. We had a bit of a blip in Libya, which wasn't really related to the Middle East conflict. You had some Red Sea attacks that disrupted some shipping, but ultimately there weren't any major disruptions in supply that really would change a major the factor in the oil market. So really what happened was demand took over, as Adi pointed out. It really was, the shock was China and how weak the demand growth was there. And the market really fixated on that. So the market is psychological. So it started with geopolitics, and it kind of fixated on demand in China. And then for the last part of the year, it's been all negative headlines about demands and everyone sort of chopping down their demand forecasts. I think this year going forward, I think we expect a lot more geopolitics. I mean, there's three main areas where we're going to have issues. One is Europe, the second is the Middle East, and the third is going to be what's going to happen with the US and China. And all three of those kind of major implications for supply and for oil markets. Now, it all sort of traces back to Trump, of course. So if he's able to get deals in those three conflict zones, then potentially we're not going to have such a disruptive year for supplies. If he doesn't get deals in those three conflict zones and goes for more standoff policies and or conflict, then you could quite possibly have major supplies, and particularly in the Middle East. And what we focus on particularly is the big question in the Middle East is about Iran. And if Iran becomes the target of Trump and or Israel, that's where you can see major implications to supply. And yes, we've got 6 million plus barrels of spare capacity, but if there is a conflict with Iran, we're talking about disruptions to the Strait of Hormuz, and that's where a lot of that spare capacity sits. So there's a complacency saying that the market can deal with it, but the one thing the market will struggle to deal with is a conflict with Iran if it then factors into the Strait of Hormuz.
Yeah, I mean, if we do see that materialize again, I mean, commentary coming towards the end of the year a lot that Trump wants to get stricter on Iran, put pressure on, but not necessarily, but avoid a conflict, obviously. And Iran, admittedly, also indicating that it is not willing to bite the bait, let's say, that's been thrown at it so far. Thanks for that, Alex. Jeff, welcome again. I mean, we touched on China, and of course, that is the big, marginal buyer of oil for all the producers, at least here in the Middle East. I mean, we're in the Europe session now, but I do want to touch on China in terms of where that's going, and because that does impact Europe, doesn't it? For example, its LNG buying can impact competitiveness in Europe as well. A lot of commentary earlier today in the Asia session about the fact that this, turnaround in its economy in terms of the refocusing of the economy to services, etc., is firmly in place. Adoption of EVs, etc. How much of a concern is that, do you think, for energy markets going forward? Is this now the year that we're going to see an even larger impact from the transition in China?
Well, I mean, it's a good question. It certainly was the topic all year long, as Alex said. When the final numbers for China growing last year, it was less than 100,000 barrels a day overall, depending on how you look at it. But this year we have it coming back a little bit up into the 200s, but it's not the go-go years, right? Where we saw 500,000-600,000 barrels a day. And it's hard to see where a big upside surprise could come from, which some people hope for and occasionally will speak about, because when you look at the types of stimulus they're putting on, as you correctly said, it's not the sort of the old style where you go build a bunch of roads. It's more support the stock market, very, sort of more the overall economy. So when we look at China ahead, it's basically in various forms of peaking right now, depending on the product that you look at, unless it's petrochemicals. And if you want some numbers to throw out there, it's about we've lost close to 1 million barrels a day through alternative fuels, whether it's in EVs or LNG that's going into displacing gas oil and trucking. So that growth would have been there, and we would have been 1 million barrels a day higher than we are today if it wasn't for that. So the impacts are real there in China. So we need to look for other areas to lead growth. And we struggle to find the next big area, maybe India. But as Adi said, realistically, we're looking at about 1.2 million barrels a day growth this year.
So an adjustment for everybody, really, especially producers, not to expect more than that. Adi, back to you. Let's circle back to Europe and talk a bit about Russia. Of course, the Russia-Ukraine conflict continues. A lot of talk that Trump wants to put an end to it and will put an end to it in the next 3 to 6 months. If we have that materialize and we have a ceasefire or a deal done, what impact is that going to make on energy markets, would you say?
Well, it will certainly have probably immediately the biggest impact. Well, actually, let me take a step back, Dyala. I actually think that a deal with Russia is quite possible, not because Trump is there and he's an amazing deal maker. I actually think that Russia is economically on its knees, and I think Putin would really like a deal, especially if he had Trump on his side to actually justify Russia keeping some of the land they've conquered. He would look great at home. He would be a victor, and having peace, he would achieve quite a bit. Now, that wouldn't necessarily mean that Europe would right away lift the sanctions and things would change. Probably as long as Putin is around, I think we probably won't see a big easing of sanctions. But it would certainly be a bearish event. The main impact of Russia is well established in new markets, such as India, China, for products they go into South America and so on. The problem is that these supply chains are very long, so the shipping rates are very high as a result, and they've tightened up since the war started, since the invasion of Ukraine. So obviously, if that was to turn around for even partially, I think the main impact would be on the shipping rates, but ultimately, the refineries are looking at the delivered cost for crude oil, so of course that would reduce the cost. And that would be a positive event, especially for the refineries that are at the moment really suffering very, very hard, especially European refiners. I mean, I was actually at the Energy Intelligence Conference speaking to quite a few people a bit earlier on in the year, last year. And it's amazing when you talk to downstream versus upstream. Our industry is right now totally divided. You talk to the refineries and it's all doom and gloom. You talk to the upstream people, everyone is positive. They're all investing money. They all see production growing, demand growing, cost reductions and everything else. So it's like talking to completely two different people, sort of as if the industry was completely split into two. Kind of industries become a split personality in a way there. And something's got to give. When you talk to the producing countries, everyone is so positive. I was talking to Petrobras in Brazil. They've got all these new discoveries, Guyana's going up. Kazakhstan is increasing their production. Chevron's just put $50 billion to increase production by 250,000 barrels. Literally, Canada, very, very positive. United States, slowly increasing constantly production. Every month we have a new peak. So it's kind of very, very interesting.
Okay, well, thanks, Adi. Let me take that to Alex then. You touched, Alex, on OPEC. That's one of the trends. Of course, what will OPEC do? OPEC plus. But let's talk about OPEC versus non-OPEC supply, because of course that was, a big factor last year. It continues to be so. More non-OPEC supply expected to come online this year as OPEC continues to hold its volumes back. does it have any other choice, really? Do those Gulf producers in particular who are leading the OPEC Plus group have any choice but to continue doing what they're doing for the full year ahead if they want to protect, let's say, a floor of $70?
Well, I mean, I think with all the uncertainty, it's really hard to say. And I think OPEC typically does what OPEC does, which is sort of look at the situation when it meets. And it's very hard, especially these days, in the last couple of years, to sort of say what's it going to look like 6 months from now. Like I said last year, in the beginning of the year, nobody was really talking about China and the huge weakness that we saw by the back end. Then it sort of dominated all sort of conversation for the back half of last year. So I think OPEC will be prudent and cautious. They're quite well aware that putting the amount of oil back in the market that doesn't need it is going to be problematic for the price. And so they will be very, I think, logical in how they're approaching things. As far as what the non-OPEC plus number looks like, I mean, this is something that, of course, was on everybody's minds. In addition to the weak demand, it's about sort of how much non-OPEC plus supply will be showing up. And so last year, I think people overestimated the amount of non-OPEC plus. Brazil disappointed by the back end of last year. And going into this year, we're more cautious on OPEC plus. We've brought it down to 1.2 million because we are cautious that there were those delays and things do happen. And so I think we're at the lower end of sort of where the non-OPEC plus number looks like for 2025.
What about, Alex, what about the US within that group? Because, of course, with Trump coming in, will that make a difference to US production? Or will it remain as it is because of the corporate decisions of those who operate?
Of course.
Yeah.
Well, I mean, this is the core question I think people are asking. Is a Republican president, and specifically a Trump president, something that could impact U.S. supply? And I think generally, and we've mapped this out over the years and looked at under Obama, Biden, Trump. And actually, there isn't a big difference between Democratic and Republican presidents on the U.S. oil industry. A lot of that is, and that's for good reason, because the government doesn't control those things. There are, of course, regulations that can help and influence that here and there, but it doesn't change the world. So I think what we see with U.S. production is, like, when you're talking about crude, I mean, oil, that is going to be hard to sort of grow at large amounts. And what we saw last year was similar to that, and not huge amounts of growth there. The liquids growth, the NGLs, that's something that's a lot more significant and will continue to be a major player in the market. And that's what I think everyone's got to keep an eye on, is those NGLs growth, particularly as you start seeing some of the increases in some of those projects we're seeing in the U.S. that will be greenlit by the Trump administration. So not a huge change in the world, I think, from a Trump administration, but whatever trajectory we've been on, I think we will stay on that.
Okay, thanks, Alex. Jeff, I mean, in terms of the trends we've discussed so far in this conversation and volatility, I mean, this question of how companies and countries can manage the volatility in energy prices, as consumers or producers. Are we facing, would you say, a more volatile year ahead with all the factors we've just discussed? Are there any strategies that those stakeholders can adopt better going forward, or do you feel that they were managed pretty well in the last year?
Well, I would say there'll be a lot of talk. I think there'll be a lot of movements sort of day to day in terms of $2 or $3 up, 2 or 3 down, week to week. But at the core, we still have a lot of spare capacity in the background. So the reality is that normally, when you have that much spare capacity on hand, you can't go up over $100 a barrel. You can't, the back of the curve just doesn't move up. So, I mean, we talk about volatility, it can be volatile, but we sort of think it'll be sort of volatile day to day around in this 70-ish type range where we are. What could move that? We've been getting questions left, right, and center about Iran recently, and we've run a bunch, looking at different scenarios. I mean, you can go 2 million barrels a day, bottom or top, in terms of what we'd expect in the market. Those are extreme scenarios, but for Iranian exports. So that's really the number one sort of wild card out there. Obviously, if Iran lost a lot of barrels, it would be helpful to the rest of the OPEC in terms of their plans. You'd have to expect that oil prices would then go up into the 80s, 80s plus, depending on how it came out of the market. But ultimately, in the background, spare capacity. Managing risk. I mean, I used to be in that business a little bit when I worked in banking. I think, a lot of our clients nowadays are sort of diversified naturally in the sense that there'll be upstream, downstream, a lot. And I think generally the prudent approach is to not do sort of knee-jerk reactions to whatever the flavor of the moment is, and just sort of stick with a hedging and risk management plan throughout the year. And usually when you look back at the end of the year and you take that approach, it's the best way to do it, realistically. Boring, but the best way to do it.
Yeah, absolutely. Safe. Adi, let's talk a bit about something that was discussed on the feature interviews earlier in this session, which is energy transition versus energy security, which has obviously come to the fore for obvious reasons the last 2-3 years, starting with Russia, Ukraine, and moving on to the troubles we've had in the region here in the Middle East. In Europe, where you sit, do you feel that the energy transition is really beginning to take a firm back seat because of cost of living, because of affordability? Where do you see that going forward in 2025? Will we see that again, coming back as the favorite, if you like, above the energy security?
Well, what I think in Europe is that there is a lot of talk about energy transition as in being expensive, maybe that we should kind of take a back seat and not worry too much about it and so on. But actually, I think energy transition is happening whatever happens, basically, whether it's Trump, whoever comes to power. At the end of the day, energy transition is about cost. Okay. And I think if you look at the cost of renewables at the moment, even in Europe, there's every reason for people to buy EVs. There's every reason for people to invest more into solar and wind power. Geothermal power is taking off big time, I think, this year as well, because there's some breakthroughs in technology, funnily enough, coming from the oil industry, actually. And I think that's an opportunity for the oil industry to explore this as a renewable type of power. So I think that's where we stand. And in terms of energy security in particular, I think, what Russian aggression against Ukraine showed was that relying on fossil fuels, to supply bulk of your industry and to build, like Germany's build a whole of industry on sort of these foreign commodities, it's very, very risky. And I think, as I mentioned earlier on, I think the main reason that the growth is falling in China is a policy, not so much economic growth. Yes, economic growth slowed down, but that was not totally unexpected. I think it's a genuine policy decision to go away from oil, because in a dangerous world, and I think we all here agree that it's probably going to be more dangerous than it has been for many, many years. I think for China not to depend on oil or for 13.5 million barrels every day, they're fully aware how dangerous that is, because in case of any conflict around Taiwan, I think Chinese economy could be choked in days and weeks, and literally would have to surrender. Because if you can just stop oil going through the Straits of Malacca, that's it. China is down, the whole economy is down, and they're fully aware of that, and they are going big time towards renewable energies, and they're doing a pretty good job.
Yeah, I mean, you mentioned the Straits of Malacca. We mentioned obviously the choke points, all these choke points that continue to exist, obviously, and we mentioned earlier that wasn't disrupted too much last year. But Alex, I'd like to go back to that point with you, in terms of how that is also that vulnerability that certain countries feel, how that might be impacting trade realignment, and then that obviously does impact energy flows. And I want to kind of get your view on what trend we might see emerge more strongly. The BRICS are adding members, etc., as we go forward. But just before that, our survey question for this particular session, which what will be the top trend impacting the direction, which is the question of the panel, and is it geopolitical tensions, uneven global energy transition, shifting trade patterns, as we just mentioned, or infrastructure bottlenecks, logistical challenges, all of the above, obviously, and we've kind of touched on all of them already. But which of those will impact things the most going forward? So, Alex, on that point of sort of in mind also that China's prepping itself for whatever those US tariffs are going to be, will we see trade blocs make should they be making more dramatic changes going forward for their own protection? How might that impact energy markets, if at all?
Yeah, I think we think about this in two ways. One is the Trump effect, and we're already seeing that. The guy hasn't even taken office yet, and everyone's
Yeah.
scrambling. So, I mean, you look at the pressure that China's under to potentially not import Iranian crude, right? You already saw the Shandong port issue warnings not to use sanctioned vessels to import Iranian crude, and we already see it in the data. The data is already down for January. For imports into China on December, based on just that single thing. The guy isn't even in office yet. You know, there's questions around what is going to happen on those ship-to-ship transfers that are happening around Malaysia and/or Oman and the UAE. Just Trump's presence, we're hearing, is already having impacts on how those countries are thinking about those sort of things. So you've got the Trump effect that kind of is there and is forcing countries and companies to think differently about the activity that they're up to. So the status quo, whatever it's been and whatever people got away with, clearly that may change. So that's one thing. And the other thing is as you point out about the BRICS and about what we've noticed over the years, which is a rising this sort of multipolar world which is thrown around as a term, but it's basically the lack of one single hegemon that can run everything. It means that countries need and will be sort of defending their own interests a lot strongly, and they are not going to be told what to do very easily, notwithstanding Trump and seeing if he can bring that sort of thing back. But what it means is if China isn't the engine of the global growth, which everyone's counted on for the last 20 years, then where is it going to come from? Is it India? Is it Africa? Is it Latin America? And so I think what a lot of producers should be thinking about and are thinking about is building those relations with those new countries that will be the future engines of growth, like India. You know, should we be doing more business in Africa? Should we be doing more business with Latin America? Because those are the future demand centers that might be the sort of engine of growth going forward. If it is, as Adi says, a peak in sort of 2030, we're in a very different world. But it really depends on how those economies grow. India is at 5 million, Africa roughly is around 5 million barrels a day, same with Latin America. If those grow the way China is growing up to 17, 18 million, then you got a very different world. If they peak and stop around 5, 6 million, and then we're looking at kind of peak demand sort of hitting across the rest of the world. So producers should think and engage very closely with those countries that are the emerging economies, and those may be BRIC economies, but they may be non-BRIC economies, but they will be developing economies.
Okay, thanks. Jeff, just back to you. Thanks for that, Alex. I mean, on the question of energy transition, again, and just looking at the Gulf countries as well, and their sort of focus going forward, there's been a lot of investment, you know, as we mentioned earlier, in hydrogen and CCS, etc., cleaning energy. But again, given the bearish outlook for oil prices, the trend is bearish, at least in the short to medium term. That impacts revenues of Gulf countries, etc. Do you see their commitment being retraced a little bit to the non-oil sector energy investment, if you like, or would you expect the trend to remain the same? Dedication to both, but focusing on the energy sector, on the oil sector.
I mean, there's probably a few things. I mean, one, I would say in terms of solar, there's still a lot of excitement. It's backing out gas. It's cheap in the Middle East. I think that will continue. Obviously, it takes some upfront capital investment, but we see a lot of interest in that, and it will continue to go. A lot of the excitement around hydrogen that I would see and we would see with clients maybe has been tempered a little bit, partly because they see more and more it's becoming the industrial policy for domestic countries. So you need an outlet. If you're going to be in the Middle East, you need to export it. But if people don't necessarily want to buy it, what do you do, right? So I would say that interest is still there, but it's sort of it's been slowing. So I would say that the interest is still there. It requires capital up front, but in my personal view, it's becoming a little more smarter and saying, okay, where will we have a real market? Where do the economics really, really work for us?
Okay, thanks, Jeff. Adi, just to go back to you on that, and from an investment point of view, again, I mean, whether countries and companies are investing in new energy tools or conventionals, again, the cost of that is obviously a factor. Just to get your take on, again, monetary policy, which obviously originates, let's say, in the US, but Europe has mimicked. The central banks have sort of followed suit in the last 2-3 years in terms of what's been happening with interest rates. Are we now in a more comfortable situation in Europe where, okay, inflation has been tempered, etc., and we see a steady as she goes going forward for the year ahead in terms of those expectations and how those might influence corporate decisions and obviously economic performance?
Yeah, there are some differences. For example, in the UK, it seems to be that inflation is still not quite as tame as we thought it was. The rest of the Europe is looking quite okay. And I think we have every reason to believe that we should see gradual fall in the rates of interest. These high interest rates certainly hit all the startup industries, and renewables have been one of the casualties, actually, because internal rates of return have dramatically fallen in the renewable industries. But that's part and parcel of every transition. You know, transitions don't happen in straight lines. We have manufacturers of, say, gas turbines for many years, you know, not doing very well. Suddenly, last year was a cracking year for them, for example. So, in terms of you know, oil industry, for example, I think we see a lot of consolidation, especially in the United States. I think we'll see some consolidation in Europe in the next few years, if not earlier, for example, with BP. I think you have to be big and strong, and it's purely defensive, because I think oil industry really has to stick to their guns to keep costs low. For example, Total announced that all the investments in oil are going into the sources where cost is below $35, because they are fully aware that if, what I mentioned early on, if we see peaking demand, which I think we will see, and falling prices medium term, what will happen? It'll have to be resilient. So the only companies that would be resilient are the companies who either have shale investments, and let's not forget shale investments is really good for the oil companies because it's short cycle investment, or longer term investments in low cost production, such as Guyana, for example, and so on. So, you know, there's a lot of consolidation, there's a lot of defensive strategies, but it will be steady as she goes. Oil industry is going to be around for many, many years. It's not going to disappear. More interesting discussion, we don't have time for it, but will be with national oil companies, what they are doing. That I find that fascinating, because most of the 60% of all the production is coming from that part of the world.
Yeah, absolutely. And of course, they're diversifying, aren't they, into different segments such as trading, etc., and becoming international oil companies as well in their own turn. Adi, thank you so much for that. And thank you to Alex also and Jeff for joining us today at the start of this European session. And of course, a few more panels to come as well. So do stay tuned in with us. And thanks again for your insights.
Thank you.
Thanks very much. Bye.